Hi, and welcome to Training Shorts by Realty and Insurance U. My name is Sadiq, real estate broker and instructor. And in this video, I want to talk to you about your buyers still buying when the interest rates are high and continuing to rise. Let's take a look at this scenario. Let's say, for an example, we have a property that $300,000, 5% down payment. The interest rate at a particular time was 3.5%. So when I calculate that, the buyer was looking at $1,279. Now, for some reason, maybe a good reason, the buyer delayed buying and the interest rate continued to climb rapidly. So now that same 300,000, 5% down at 3.5%, at a rate of 7%, now we're looking at $1,896, a little over $600 more. Now, guess what? The buyer may not want to go through with that. They say, hey, listen, I'm going to wait. And that's not what we want to hear our buyers say. We don't want to just leave it at, okay, they say they're going to wait, but hey, there may be a situation that we could get something done. So the first thing that you want to do is, if your buyer was comfortable at 3.5% paying $1,279, what I want to do as interest rates begin to fluctuate is find that target purchase price. When I say target purchase price, that purchase price that will give the person that same monthly payment that they were interested in paying. So if I reduce this 300,000 down to 202,000, and at the current interest rate of 7%, and calculate, we are at 1276. So the reality is for that person to be in that same situation, you're talking about a purchase price of 202,000. Now let's look at some examples on the PowerPoint here. Let's go back over this example. So we're talking about a situation with a purchase price, 300,000 at 3.5%. Principal and interest, 1279.78. They waited a while. Now the purchase price of 300,000 at 7%. The principal and interest is $1,896. Now we're talking about a difference of $616. And your buyer's telling you they're not doing that. So now we got to think of a strategy. So the first thing you're going to do, like I said before, whenever interest rates are rising, find where that target purchase price is to give the buyer this somewhat of the same monthly payment that they would have had if they purchased back here when the interest rate was low. So that purchase price is 202,000. So at this particular point in time, you have three options. One, you can talk to the seller and say, hey, listen, I know people were offering you $300,000, but we can offer you $202,000 for that same property. Now, we'll tell you, that conversation is not going to go over well. Okay, it's not going to go over well at all. But that's one option. Second option, you can go to the buyer and say, hey, listen, I know you qualified for $300,000 last month, but this month you qualify for $202,000. Now that's going to be a tough conversation too, because, and especially if you've already taken them to see $300,000 houses, and now you have to take them to see $202,000 houses. So that's going to be a tough conversation as well. Let me tell you what a better conversation is when the interest rate spread is like that. That number three is rehab loan options. Look at doing a rehab loan for your buyer. You know, they have FHA 203K, they have home style renovation loans. There's a few others out there, but the bottom line is this: instead of looking for the property in excellent condition, move-in ready, rehab loan, we're going to find the property in the worst condition in the neighborhood that needs rehab, new roof, new everything. That's the house that we're looking for. So once we find that particular house, now what we're looking at is the move-in condition homes, like we were saying, 300,000. We can't get that now because the interest rate has risen, right? So now we're looking for a property in that same neighborhood or a nearby neighborhood that's damaged where we can get that property for 162,000 for an example. Rehab budget of 40,000 to rehab the whole house, all in at 202,000 at 7% equals a principal and interest payment of 1276. So now you can get a brand new house, because remember, when they rehab it top to bottom, it's going to be a brand new house. And they're still at the same payment of 1276, still around the same area as far as the payment is concerned. And one step even further, I mean, even better, is that if that property appraises for 300,000 and they all in at 202, you're talking about walking in with equity at $98,000. Okay. But this is the perfect scenario to get the monthly payment just like it would be here, something that they would like to pay. Let's say we have to increase the offer. Let's say we increase the offer and we find a property and they accept something like 210,000 and the rehab is 40,000. Now you all in at 250,000. Okay. At 7%, the principal and interest payment is 1,580. That's just $300 more than they were expecting at the 1,279. Hey, that's better than 616 extra, correct? And if 300 is too much, hey, negotiate somewhere in the middle. Maybe do $150 where they just paying an extra $150 a month. And maybe that'll work. Maybe that'll work. But the idea is, don't just let your buyers tell you the interest rates are high, so I'm going to wait. There are options that you can use. And always keep in mind when you do the rehab loan, even if they're all in at 250,000 and that property after it is rehabbed appraised for 300,000, they have equity of $50,000 in the home. So make sure you bring that up to your buyers as well. So don't just let your buyers tell you that the interest rates are high, I'm going to wait. Present some of these options to your buyer. Now remember, you can have the seller reduce the expectation, you can have the buyers reduce the expectation, or you can do a rehab loan. It all depends. When that interest rate is that far apart, the spread is too large to probably negotiate. But if the interest rate starts dropping below 7.65, then you may get into that range of negotiation. So it all depends. But the idea is this: make sure you get that target purchase price and then start working out scenarios, especially when the interest rate spread is like it is from the expectation that people were expecting just a short few months ago. You may want to look at a rehab loan option. Okay. Hope this information was valuable to you. Thank you for participating in Training Shorts by Realty and Insurance U. Have an excellent day.